Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hello, class. Welcome to Analyzing and Trading Options 101. This is the College Investor Audio Show. All right, so trading options can give investors more leverage than trading stocks. Whereas a stock may require the trader to put up to 50% of its value, many options only require 10 to 20%. That's a good thing. That's a significant difference. Each option also allows the trader to control 100 shares of the underlying stock. So in this 101 guide today, we'll look at single-legged options strategies. That means buying single options contracts. Some strategies involve pairing different options contracts and even using more contracts to open a single trade. But those types of strategies are beyond the 101 level. Options versus stock trading. Let's take a look at that first. So an option is a derivative of the underlying, or stock. If the stock didn't exist, the option wouldn't exist. It's simply a mathematical financial creation. The stock represents a real company and isn't just a mathematical representation of something else. Buying stock is a simple transaction. Enter the number of shares and click buy. Now you can get a little more targeted with your price by setting a limit order. Now, for example, if ABC stock is trading at 105 and you want to buy 25 shares at $100, you set a limit to buy at 100. Your buy order will only be triggered when the stock price reaches 100. Once the order executes, ABC needs to go up for your trade to make money. That is called a long trade, as opposed to a short trade. Price of ABC goes down. Options can be purchased in a similar manner. Instead of shares, you deal with contracts. Each options contract represents 100 shares of the underlying stock. Also, you aren't buying contracts based on the underlying stock's price. Instead, you're buying based on the options price. Let's do an example. On March 17, 2021, ABC was trading for 105. The ABC April 110 call option contract was trading for 0.80. Let's clarify what these prices actually are. 105 is the last traded price. ABC has a current bid by ask of 104.50 by 105.25. Now, this means the next trade will probably be just under 105. The ABC April 110 call contract has a bid by ask of 0.75 by 0.80. Its next trade may be under 0.80. The bid by ask values are called a spread. In liquid stocks, the spread is very small, same for options contracts. Options contracts can have a large bid by ask spread, even if the stock is fairly liquid. A large spread means you're more likely to pay more for the option than if it were liquid. Calls versus puts. You may have noticed this. The call options price moved down with the stock price, or bid by ask to be more precise. A call option is also a long trade. As the stock price rises, the call option price rises with it and vice versa. However, the option price moves at a different rate, usually slower from the stock price. There's something called the Greeks that determines how quickly the options price rises compared to the stock. But the Greeks are an advanced topic, not for 101, that's for sure. If you are betting that the stock price will go down, you want to buy a put. As the stock price moves lower, the put price moves up. I know, it seems the opposite of the call option price behavior, but since you are buying to open the option position, the trade only gains value when the options price moves up. Options nomenclature. So, in the example we just shared, we bought the ABC April 95 call option contract. What does all that mean? ABC is, of course, the underlying that the option is based on. April is the month that the option expires. This is a monthly option. All monthly options expire on the third Friday of the month. That means the option will expire on April 15th. You have until that date for the option to gain in value over what you paid for it. Some options expire every week or few days. The 110 is called the strike price. It represents the stock price that you believe ABC can at least reach before April 16th. What happens if ABC is only at 105 by April 16th? Basically, the option you purchase at 0.80 will be worth 0. Each option is worth 100 shares of the underlying. Because you paid 0.80 for the option, that means it cost you 0.80 times 100 equals $80. So you would lose $80 in this case. If ABC went to 115, the option would likely be worth more than $80. Let's say the price increased to 1.25. Then you would make 1.25 times 100 equals $125 minus $80 equals $45. Now we're getting somewhere. Commissions. You've probably heard that brokers no longer charge commissions on stocks. That's also true for options. But not exactly. Sounds like double talk, right? Here's what we mean. Before brokers removed commissions, options traders would pay a base commission plus a fee for each options contract. It might look like this for 5 contracts. So the base fee is $1.50, contract fee $1. Old total cost, $1.50 plus $1 times 5 equals $6.50. New total cost, $1 times 5 equals $5. The base fee has been eliminated, but the contract fee remains. So in a way, commissions didn't really disappear for options. They just reduced them. And we're thankful for that at least. Now we haven't talked about options leverage or margin. That's also a bit more advanced, but this podcast today should help you at least with the basics of options trading and understanding how it works. There's a lot more to learn though, when choosing the right strike, expiration, trading multi-legged configurations, and analyzing the Greeks. And it is kind of like Greek. If you want to dig a little bit deeper, you can do that at thecollegeinvestor.com. I know some of this stuff is kind of confusing in a podcast. We're just trying to get your wheels turning a little bit to dig a little bit deeper in this. It's very exciting and kind of fun, too, to learn about it. Find out more at thecollegeinvestor.com. Thanks so much for being with us today. We'll talk to you again very soon.